Are you a first-time homebuyer considering using an FHA loan because of the minimal down payment and the lower credit scores that it allows? Well, then you absolutely want to pay attention to this video because we're going to discuss some of the FHA myths, some things that you probably need to know but maybe don't want to know when it comes to FHA loans. The reason you might not want to know them is because it makes it a little bit more difficult to qualify. It may make the FHA loan that you think is this big, great thing become not so great at the end of the day. Now, I want to be very, very clear. FHA loans are really, really good loans, but some of the things that FHA allows are a little bit more difficult to qualify for. And just because you meet some of the guidelines doesn't necessarily mean you're going to qualify for an FHA loan. And that's exactly what we're going to talk about in today's video. Now, the very first myth I want to talk about is the idea of FHA guidelines being universal. FHA guidelines are universal in writing from FHA. But here's the thing, each lender interprets those guidelines a little bit differently, and some lenders have overlays on those guidelines, which means even though FHA allows it, that particular lender that you're getting approved with may not necessarily allow it. And some of the examples that I'm talking about here is FHA allows credit scores as low as 500 with a 10% down payment. They also allow credit scores as low as a 580 if you have a 3.5% down payment. But with that said, if you have a 500 credit score, even if you have the 10% down, or maybe you have a 580 and you have the 3.5% down, even though you have those, doesn't necessarily mean the lender is going to qualify you because that lender may have actually put an overlay on those guidelines. What is an overlay? An overlay is an additional guideline on top of the original guidelines, basically saying they need a little bit more criteria, a higher credit score, if you will. So with that said, some lenders out there won't do an FHA loan for you unless you have, say, a 640 or a 650 credit score, making it super difficult to qualify. So even though you meet the basic guidelines for FHA, doesn't necessarily mean that lender is going to do the loan because of the overlays that they have. So just make sure when you're going through the pre-approval process, you're working with a broker, you're not going into your bank. And the reason I say that is because banks, credit unions, those types of institutions typically have more overlays than, say, a broker. A broker has access to multiple lenders. So if you don't fit in box A, they can take you to, say, box B or box C or box Z for that matter, basically to a lender that doesn't have those overlays. So in theory, they have more options, which means that you have a better chance of qualifying. Now, if you don't know where to start in the process, you need a lender, you need a broker, do me a favor and check the link below. Now, at the same time, the second myth I want to talk about kind of goes along the same type of thing, that even though FHA says you need a 500 credit score, that's the minimum for 10% down, or a 580 with 3.5% down, even though you have those credit scores and you have the down payment, doesn't mean that you're going to qualify for the loan. There are other requirements and you have to meet all of those guidelines. And the reason I bring this up is because I'm often having conversations with my lender who's saying, hey, listen, I received a call from somebody that had a 580 credit score, they had the 3.5% down payment, and they still didn't qualify, and they were wondering why. Well, it's because they didn't meet the employment guidelines or they didn't meet the debt to income ratio requirements that FHA requires. So just understand, just because you check one of the boxes on the FHA guideline requirements with regards to having the down payment or having the credit scores doesn't mean the lender is going to approve you for the loan. You can't just meet part of the requirements, you have to meet all of the requirements in order to meet the lender's guideline and ultimately qualify using that type of financing. Now, please understand, I don't want to come off like FHA loans are super difficult to qualify for because honestly, they are the most lenient program. They are the easiest to qualify for because they allow the lowest credit score. They allow the lowest down payment, and at the same time, they allow the highest debt to income ratio, which means they allow you to use more of your monthly income towards debt, which in theory means that you should be able to qualify for more home using FHA than any other type of program. And that's really the third myth that I wanted to debunk in today's video. A lot of people believe that because FHA only allows a minimal down payment and they allow lower credit scores, that it's harder to qualify for that loan. In fact, it's not, because the guidelines are very, very flexible. But with that said, you just have to make sure you're working with a lender that has access to FHA without those overlays. Now, the reason it can be a little bit more difficult to qualify for these FHA loans, one thing I didn't mention earlier, is the fact that it requires a manual underwrite once you get to a certain credit score. What happens is when you go to apply for a loan, your lender is putting it into an automated underwriting engine, which is more or less spitting out a result whether or not you're approved based on their guidelines. But sometimes when your credit scores are lower and you're kind kind of sitting in that gray area, if you will, it requires a manual underwrite on that loan. And when your loan goes to be manually underwritten, they're a little bit more strict on what they're looking for. So even though you have the credit score, you have the down payment, you meet the majority of the requirements, doesn't necessarily mean you're going to get approved, because now an underwriter is taking a fine-tooth comb and going through that loan. Now, the fourth myth I want to debunk in today's video, or talk about rather, is the idea of house hacking using an FHA loan. Now, I'm a firm believer that if you can use FHA and house hack, it's great. It's a great way to buy your first property, having someone else help pay the mortgage on that property. But with that said, it's not quite as easy as many people out there are making you believe. What I mean by that is I often have people reaching out to me and my lender talking about wanting to buy a property, say a single family home, and they're going to rent out the rooms of that property. They're going to take the rents from those tenants in order to help them qualify for the mortgage. Unfortunately, that's not going to work when it comes to using an FHA loan, or any loan for that matter, unless you have a history of doing that, which basically means a lender is not going to allow you to use the rents from potential roommates unless you have a history of showing that that's something you've done in the past on your tax returns. So in the case of trying to house hack and buy a single family home and rent out the rooms, yes, that may actually work with your thoughts on how you're going to pay the mortgage, but unfortunately the lender isn't going to allow you to do it based on how they underwrite the loans. And that's going to take me into the idea of saying buying a 3 or 4-plex using FHA with a minimal down payment. One of the nice things about FHA is that you can buy a 3-4 unit property and just put the minimum down payment of 3.5%. But with that said, FHA has an additional requirement that they require on 3 to 4 units. It's something called the self-sufficiency test. And in many cases, it can make it very, very difficult to buy a 3 and 4 unit property, especially in high cost areas like here in Southern California, because of this additional requirement. The self-sufficiency test basically says that you have to take 75% of the rents on that property, and those rents have to be able to pay for the mortgage, the taxes, the insurance, any cost associated with that property. So let's take a $750,000 home, for example, that's a 4-unit property. Let's say that you're going to live in one of the units and rent the other 3 units out. And let's say each one of those other units rent for around $2,000 per month. So in that case, you'd be bringing in about $6,000 of income. Well, once you take 75% of that, that's $4,500. So in theory, that $4,500 would have to cover the entire mortgage, including the property taxes, including the mortgage insurance, including the insurance on that property, in order for FHA to allow you to purchase it with just 3.5% down. Well, unfortunately, that's not going to work because it's not going to meet the guidelines. I ran the payment on a $750,000 property, putting just 3.5% down, using an interest rate of 5.5%. And the mortgage payment alone on that property is $4,109 per month. The property taxes would be roughly $687 per month. On top of that, you would have mortgage insurance at roughly $512 a month. And then you would have property insurance, roughly $200 per month. So all in, your mortgage payment would be $5,509. So even though the $6,000 in rent that you're getting from those units cover your entire mortgage payment, by taking 75%, which is the requirement, you don't meet the guidelines to buy that property. And that's one of the biggest myths when it comes to FHA loans, is people think that just because FHA allows it, that it's going to work on every single property. And unfortunately, that's not the case. Another big myth that I hear quite often is that FHA loans are only for first-time homebuyers. That's not the case. FHA loans can be used by any buyer at any time. Even if you've purchased using an FHA loan before, you can purchase using an FHA loan again. In fact, you can actually have more than one FHA loan at a time. Now, there are some additional requirements when you have an FHA loan and you're buying another house using an FHA loan, which is basically the 100-mile rule, that your next FHA purchase has to be more than 100 miles from the existing FHA loan. But in keeping with the theme of this video, the myth is that they're only for first-time homebuyers, and that's simply not the case. Now, before we dive into the next myth in this video, I want to take a minute here and tell you that I've created a first-time home buyer course to guide you through the process of buying a home, whether you're using FHA, whether you're using conventional, USDA, VA, it doesn't matter. It's really an A to Z on buying a home. So if you're a newbie to the process, or someone that's maybe bought and sold just a few homes and unsure about the process, but would really like to become educated, well, I created this first-time home buyer course exactly for you. So do me a favor and check the link below. Another myth I hear all the time when talking about FHA loans is that FHA appraisers, FHA appraisals are way more strict. And that's simply not the case. Yes, FHA requires a couple of additional things when the appraiser goes out and views the property, but they're no more strict than any other appraisers. They're just making sure the home meets FHA guidelines. And usually what people mean by this is they go out to a property that needs a ton of work, a property that's about to fall down. They're like, it doesn't meet FHA guidelines. Well, chances are it's not going to meet any guidelines with regards to financing if that's the case. But FHA is looking for things like peeling paint. They're looking to make sure the property has a heater in the property. They're making sure that it has appliances in the property, things that you actually want in a property. But as far as appraisers being more strict on the value or FHA appraisals not coming into value more than conventional loans, that's simply not true. And another thing I often get questions about when it comes to FHA and myths is the idea that because you buy an FHA loan and you have to live in the property because that's one of the requirements, it's only for primary homes, is that people believe that they have to live in that property forever, or if they move out of that property, they have to refinance out of that loan. That is not true. You can actually get an FHA loan to purchase a home, and let's say after a year of living in that property, you want to turn that property into a rental and go out and buy something else. Well, you can do that, and you can keep the same loan on that property. You can keep the FHA loan on that property. You don't have to refinance. You don't have to sell that property, because your agreement with FHA is not that you're going to live in the property forever. It's that you're going to occupy that property upon closing. So at which point you change your mind, then there's no harm, no foul. Now, one of the last myths I want to talk about in today's video is probably one of the most important, and that's the idea that you shouldn't get an FHA loan because it has mortgage insurance for the life of the loan. And I believe this to be completely untrue. In fact, I've had several clients get property using an FHA loan because they only had a minimal down payment. And if they had waited and saved for, say, a 20% down payment where they wouldn't have had mortgage insurance, it would have taken them years to come up with that down payment. So instead, they decided to buy a home, and they were lucky enough to see appreciation within a couple of years. And with that, they've been able to refinance out of that FHA loan into a conventional loan and get rid of the mortgage insurance. Whereas had they waited until they had the full down payment, they probably still wouldn't own a home today. And not only that, they would have missed out on the appreciation that they gained during that time, along with the principal they paid down on their loan. Now, I'm not going out there telling you that you need to get an FHA loan, but at the same time, I'm also telling you that FHA loans aren't all bad just because they have mortgage insurance. At the end of the day, you have to do what's right for you. So when you're getting comparisons, you're talking to a lender, just have them run the numbers side by side. Have them run an FHA loan, compare it to a conventional loan. At the end of the day, the numbers never lie. So you can make a decision on which loan's best for you. If waiting and having no mortgage insurance is best for you, then great. But I wouldn't get caught up in the idea that you can't buy a home just because the loan has mortgage insurance. Because understand, at some point in the future, you can likely refinance and get out of that loan, and it keeps you from waiting until you have that full down payment. Now, if you're someone just starting the process, not 100% sure if an FHA loan is right for you, not sure about all the guidelines, do me a favor and check this video here.